Hello, my dear valued viewers. Here is Vishalakshi Rajapantala, and you're watching Learn Stock Market Day Trading YouTube channel. Earlier, Trading Tricks for Indices YouTube channel, and I have changed this name. I am thrilled to have you join us for informative and insightful discussions on the latest trends and strategies in the stock market. Whether you are a seasoned trader or just starting out, we are decided to providing valuable content that will help you navigate the dynamic world of day trading. Disclaimer: this content is for educational purpose only. And the video is about making money with the institutional investors. Most of the research analysts and many YouTube channels keep says that if you are with institutional investors, you are going to earn big lots of money, and if you are against them, you are going to lose most of your capital. And let's see in the video how to know institutional investors investing money in the market. And the agenda of this video is the introduction about institutional investors, where they put money in the market and what is the indicator to be used with them, and the examples. By the end of this video, you're going to apply this knowledge in your day trading or positional trading. Let's get into the video. The introduction. Institutional investors are large organizations such as pension funds, insurance companies, endowments, and mutual funds. If you see, every job holder pays pension every month. Okay? To get that fund by the end of their service. So likewise, insurance companies also collects the premiums of the job holders to give them, if anything went wrong, they give that money to their families. And mutual funds also, if you want to invest in a group of stocks, you can go for mutual funds. So these companies are having lots of liquid cash due to the inflow, because pensioners will be taking their amount by the end of their service. Likewise, insurance companies having liquid cash and they are paying just 0.01% casualties. Okay, so these companies are having high lot of liquid cash. To invest that money at some companies, they want to invest it in the stock market. This is the hidden thing about institutional investors. There are nothing but the insurance companies, endowments, and mutual funds, and also banks. Banks are having high liquid cash, so they want to put their cash in a form to generate some income. For example, uh, insurance companies are having thousand subscriber base or thousand clients. Those thousand clients are paying you every month the premium, or for every 3 months or 6 months they are paying the premium. And in that 100 members, 100 or 1000 members, there is only 0.01% or something like below, there are affecting their lives. That means there are 0.01% of accidents or something like that. You know that insurance companies pays to those they are affecting by accident or some other issues in their lives. So they are having high liquid cash. That cash will be gone into the stock market, so that they will generate some income. These investors typically have significant amount of money to invest and therefore influence the stock market, because when they are investing at such big lots of money, the movement of the stock will turn around. Okay, I will explain this with the examples also. Keep watch this video even though you have some doubts. Institutional investors have a professional investment team and often have a longer term investment horizon, and individual investors, they are having professional investment staff to put the money in the markets, because putting money at some random stock is not at all a good idea. If you are investing in a penny stocks and you don't know what that company is doing and what is it making, you don't know anything, and you are just putting your money in that stock, definitely that is a loss. So these professional investment staff do their research, and they are having the reports with them where they want to invest their money in those particular stocks or indices. They can have a significant impact on the stock market because they can buy or sell large blocks of shares at once. I will explain this in the example part so that you will understand it much deeper, and it can affect the price of the stock. The institutional investors can affect the price of the stock. And when the second part is when institutional investors put money in the market. This is the main important question I have to answer, because if you know the answer for this question, you are going to have some more edge by your side in the day trading. Now the answer is institutional investors can put money into the market at any time. Yes, any time. They don't have any particular time to do that, depending on their investment strategies and market conditions. Okay, for example, when you see the COVID-19 situation, for months the indices are falling down, and suddenly one day at some point of time there is a huge movement in the market. I clearly remember that day there is a huge movement in the market where everybody is expecting the market to fall down, but the institutional investors has their own strategies, investment strategies, and they put the market in a different mode, that the green candles are blowing up all the stock market. Okay, everybody has amazed about what is this, what happens to the stock market, why this suddenly these big elephant bars are appearing in the charts. So the answer for that is institutional investors have put their money into the market. So they typically have a long term investment horizon and may use a variety of investment approaches. They can use any variety of investment approaches, but what we have to do is we have to be with them. So we have to read the institutional investors data. I'm going to do a video about how to read the sentiment of the institutional investments in the latter part of the videos. Okay, they do the investment approaches such as value investing and growth investing to achieve their investment objectives. Now, institutional investors may invest a wide range of securities. Yes, wide range of securities, including stocks. They can buy stocks, or they can invest in indices. They can invest in bonds, real estate, and commodities. Commodities are nothing but gold, silver, wheat, something like that. They may also invest in alternative investments such as private equity or hedge funds. This is a big concept if I discuss about hedge funds, some private equities, everything in this video. Our goal is to learn about institutional investors and what indicator we have to use to be with them. Now let's get into the video a little bit deeper. Okay, now institutional investors may invest in market through direct purchases of securities or through the use of investment vehicles such as mutual funds, exchange traded funds. Yes, they put their money through stock market directly in the stock market. They put their money, and in other way they put their money as mutual funds or exchange traded funds. Mutual funds are nothing but a combination, a group of 4 or 5 blue chip companies. Chip companies are nothing but strong foundation companies where they cannot wipe out in a single night. That means government companies like ONGC, ITC, something like that. There are a well reputed companies are blue chip companies. Examples of blue chip companies is Nifty 50. If you see Nifty 50 companies, most of the companies are blue chip companies. That states that those companies are not easy to wipe out in a single day or single night. you can have your faith in those companies 99%. So they invest, these institutional investors invest in mutual funds or exchange traded funds. They may also use derivatives such as options or futures. Like in stock market, you can directly buy the stock of the ONGC, or you can buy the options or futures of that ONGC. There are different kinds of instruments or vehicles are there to make money from the stock market. Once you understand all these concepts, you can choose your own type of trading style. Okay, these are called institutional investors, and overall institutional investors play an important role in the stock market and can have a significant impact on stock prices and market trends. I have discussed this point earlier in this video because in the COVID-19 situation, everybody thinks that that day is going to be a downtrend day or a sideways day, but suddenly the market has moved itself by 1200 points, and that is the shift of the trends. Now let's get into the indicator part. What indicator you have to use to be with institutional investors? That is 20 EMA. Actually this is 20 SMA, but 20 exponential moving average is a technical indicator that is commonly used by traders and investors to analyze stock price trends. SMA is little bit slower to impact the chart, but exponential moving average is little bit faster than SMA. So I personally use 20 exponential moving average in my charts to analyze the trends. Now let's get into the charts and I'll explain about it. For example, if you see here, this is the 20 EMA, and if you don't know how to put the 20 EMA in our charts, I will tell you. Okay, this is the 20 EMA. I will tell you. You have to go here, the indicators, metrics and strategies part, and search for EMA. Like this, search for EMA, and you are going to get EMA for 20. Okay, in this way you can put it in your charts. Okay, this is the EMA, 20 EMA, and if you see here, when the price goes in upward direction like this, from here to here, the price is moving in this direction. The 20 EMA is supporting the price to move upward direction. Once it has moved below it, okay, once it has moved below it, the price supports 20 EMA supports the price to fall down. Most of the time it looks like this. For example, in Nifty also, if you see here, the price is going till here, and once it closes below it, the price is respecting the 20 EMA to move downwards. Once it again gets pull back towards 20 EMA, again it is rejecting. So this is called institutional investing. I'm not saying that this is the only way you can know about what is the action of the institutional investors, but this is one of the way. 20 EMA is one of the way to understand what they are thinking. This is not always right, but some of the days it shows like sideways days. On these sideways days, you may not get accurate entry points. Those days your stop loss may triggers very frequently. So what you have to do is, when you are using a system, merge that system with the 20 EMA. For example, I am using CPR pivot points. I would like to merge these CPR pivot points and 20 EMA in my charts, and I will get the edge in the market. For example, my strategy is to go short at this point of time. Okay, this point of time I want to go short, and it is showing that the price has closed below 20 EMA and I have another 10% of confirmation that this is going to be worked out on this particular day so that I can increase my position size. This is the way you have to think. When you are having two different indicators is showing the same your pre-market analysis or your strategy in the market, then you can act upon with more confidence. Okay, you can invest more of your money at that point of time. If you invest this after the close of this candle, you can have a good amount of risk reward here. Now I'll tell you, take you to the charts here. For example, if you see here, this is the 20 EMA and the price is respecting the 20 EMA, isn't it? It is moving upwards and the price is respecting the 20 EMA because institutional investors are with 20 EMA. When they invest money, the movement at 20 EMA is going to rise like this. Okay. Sometimes it is showing like this sideways day, but not an issue if you follow a system like this for a good amount of time. You will understand when to invest your money, when to place your money, when not to place your money. For example, if you see here, this is also an indication that the price is going to move upwards at this candle. But if you are familiar with CPR pivot points, if you do your pre-market analysis, there may be a chance that this day is not going to be a trending day because the CPR is wide. So you don't take your trade at this point of time. This is called analysis, and once it is closing below 20 EMA, you're going to have a good edge in the market and you place your money after the close of this candle. Put your stop loss above this candle and you wait to take the profits of 1:2 risk reward or 1:3 risk reward. This is like this. In pure trending days, 20 EMA is respecting, price is respecting the 20 EMA. I'm not saying that every single day it is doing like this, but most of the time. If you are accurate in your entry, exit and stop loss, you can make money. For example, this is the uptrend day and the 20 EMA is below the price. See here. Below the price is respecting the 20 EMA. Even though it closes below it, immediately there is a buying pressure and again moves above the 20 EMA. See here also, but it depends on various factors. You have to understand those factors. Now what is the final part? Yeah, I have explained with examples and what is 20 EMA and how you can use this 20 EMA and with the institutional investors. Thank you so much for watching my videos. If at all you like the content, please like and share this content. Thank you.